Let's talk about Sarah. In 2024, she bought shares in Innovate Corp, a company hyped for its revolutionary battery. The stock soared at first, $100 to $120. Sarah dreamed of new possibilities. Then a competitor launched a cheaper battery. Innovate's stock slipped, first to $115, then $100. Sarah shrugged it off. It'll bounce back, she thought. But the slide continued, $90, $70, $50. Her optimism faded into anxiety. She stopped checking her account daily. The pain was too much. Years passed. By March 2026, Innovate Corp traded at $30. Sarah's investment was down 70%. She could have sold earlier and saved most of her money, but she clung to the hope of breaking even, anchored to her $100 entry price. The dream shifted from profit to simply not losing. She read old news, trying to reignite hope. She wasn't investing anymore. She was trapped by her past decision. The number $100 haunted her. Selling for less felt like failure. Sarah's story isn't unique. Millions fall into this psychological trap. It's not about the company anymore. It's about avoiding the pain of loss. The longer she held, the harder it became to let go. Her money sat idle, missing out on better opportunities. This is one of the most powerful forces in investing. Don't let it control you. Watching a stock fall is an emotional ride, not a logical one. First comes denial. It's just a blip. Then anxiety creeps in as the stock keeps dropping. Hope turns into bargaining. If it just gets back to what I paid, I'll sell. The focus shifts from the company's future to your own entry price. Fear and desperation follow as losses mount. Selling now feels unbearable, so you do nothing. Some stop checking their portfolio, hoping the pain will fade. Inaction becomes a decision, to keep holding a loser. Eventually, resignation sets in. Some finally sell at the lowest point, locking in maximum pain. Others hold forever, letting dead money linger as a reminder of past mistakes. This cycle is common and costly. Emotional traps keep us from making rational decisions. Recognize the pattern before it traps you. Break the cycle. Why do we cling to losing stocks? It's called loss aversion. The pain of losing is about twice as powerful as the pleasure of gaining. Kahneman and Tversky proved our brains are wired to avoid losses. Imagine finding $100 on the street. Nice, but fleeting. Now imagine losing $100 from your pocket. The sting lingers. That's loss aversion at work. When a stock rises, the gain feels good but temporary. When it falls, the pain is sharp and real. Selling at a loss feels like admitting defeat. So we hold, hoping to avoid that pain. We tell ourselves it's not a real loss until I sell. Our instincts push us to gamble on a recovery, even when odds are low. This defense mechanism keeps us stuck. The desire to avoid pain overrides logic. Recognize loss aversion and don't let it dictate your decisions. The break-even fallacy is a classic trap. We fixate on getting back to our purchase price as if it's a finish line, but the market doesn't care what you paid. Your entry price is a sunk cost, irrelevant to future decisions. Rational investing asks, is this stock a good bet for the future, right now? Breaking even is harder than it seems. A 50% drop requires a 100% gain just to recover. The deeper the loss, the steeper the climb. While you wait, your money is trapped, missing better opportunities elsewhere. Every dollar stuck in a loser is a dollar not working for you. The break-even fallacy keeps you in bad investments and out of good ones. Don't chase ghosts. Focus on future potential, not past mistakes. Free your capital to grow. We love stories, and we get attached to our investments. A stock can become part of our identity, not just a financial asset. Emotional attachment clouds judgment. Confirmation bias kicks in. We seek good news, ignore the bad. We become fans, not analysts. Selling feels like betrayal, especially if we've bragged about our pick. Ego gets involved. Selling for a loss feels like public failure. We treat stocks like pets, nurturing them even when they're sick. But stocks aren't pets. They're tools for building wealth. Loyalty to a losing stock is costly. Don't let emotion override logic. If the story changes, let go. Your portfolio isn't a family, it's a business. Make decisions accordingly. Professionals feel loss aversion too, but they use rules to protect themselves. They set exit strategies before buying price targets for gains, stop losses for losses. For example, I'll sell if it drops 15%. The rule is made when calm, executed automatically when emotions run high. They focus on the investment thesis. Is the original reason for buying still true? If the story changes, they sell, regardless of price. Accountability matters. Teams or journals force clear reasoning. For individuals, write down your thesis and rules before buying. Review them when things go wrong. Rules beat willpower. Process beats emotion. That's how professionals avoid disaster. You can too. The stop-loss order is your best defense against holding losers. It's a preset instruction to sell if a stock falls to a certain price. Decide your maximum acceptable loss before you buy, say 10%. Place the stop-loss order. If the stock drops, it sells automatically. No hesitation, no emotional debate. This discipline protects your capital from catastrophic losses. It forces you to confront risk up front, not just dream about gains. Stop losses aren't perfect. Sometimes you'll sell before a rebound. But over time, cutting losses early beats hoping for miracles. It's not about timing the market. It's about managing risk. Use stop losses to keep small losses from becoming big ones. Protect your portfolio from paralysis. Let rules, not hope, guide your actions. Here's a powerful mental trick, the would I buy it today test. For every losing stock, forget your entry price. Ask, knowing what I know now, would I buy this stock today at its current price? If the answer is no, sell it. Holding is a choice. Every day you keep a stock, you're effectively buying it again. This test cuts through emotional baggage and focuses on future potential. Take Sarah's Innovate Corp. At $30, would she buy it now, knowing the competition and outlook? Probably not. So why hold? The test reframes your thinking, removing sunk costs. Your portfolio should be a collection of your best ideas today, not a museum of past mistakes. Regularly apply this test to keep your money working for you. Clean house, stay objective. Invest for the future, not the past. Keep an investment journal. It's your secret weapon. Before buying, write down your reasons, expectations, and risks. This forces clarity and logic. When a stock falls, revisit your journal. Has the original thesis changed? Did the risks materialize? If so, selling is a logical step, not an emotional reaction. Over time, your journal reveals patterns in your thinking. You'll spot your strengths and weaknesses. Honest self-reflection leads to better decisions. Turn losses into lessons. Let your journal make you a smarter, more disciplined investor.